All right. Welcome everybody to Protect the Pile. This is the inaugural episode. Commence the fireworks and all the other associated hoopla. I am Patrick Kent, or RPK, and with me is Sam Rahman and Robert McGroarty, with both portfolio managers and colleagues at Hedgeye Asset Management. Hey guys.
Hey, good morning.
We
Right.
uh we did an extensive survey of the media landscape and decided that what the world was missing was another podcast show. I think seriously though, the goal of the show, I think, as we've talked about between the three of us, is to really, be able to talk about the investment landscape with a panel of practitioners who play the game every single day and have been doing it for years, with all the associated battle scars, like, or Sam likes to quote, I think from your piece a few weeks ago, one of the all-time great movies, Raiders of the Lost Ark. It's not the years, it's the mileage. Um, We'll cover a few topics we think are worth discussing and close out with a few quick observations and hopefully have some fun along the way. So, how are you guys doing?
Doing good, man. Looking forward to it.
Yeah, should be a good one.
All right. It's our first one. This is good. You're about to be part of a new hit financial podcast slash show or whatever we call these things now. All right. Uh, First, let's level set. S&P 500 flirting with all-time highs. Same for the Nasdaq. As of now, they're up, what, 16%, I think 23% year to date. And that's actually trailing some of this, like Europe, Asia, on a constant currency basis. These have been even stronger. It's been an interesting few weeks. Several volatility spikes. Some noise from the financials around credit. Jamie Dimon got some press with his cockroaches comment. You never have just one, right? Despite that, high yield spreads remain tight. The VIX has settled comfortably into what we at Hedgeye call the investable bucket. The artificial intelligence spending spree continues with all the restraint of a drunken sailor, though Zuckerberg may be passed out at the party already. Somebody should check on him. Um, that CapEx spend is projected to roll through 2026 pretty much. We're talking hundreds of billions flowing into next year. Could small caps be a best beneficiary? I mean, for those who've been faithful there, they've been long suffering, but could finally outperform. We'll get to that. It wouldn't be Halloween if there weren't a few scary things out there. There's some questions about the circularity of AI financing. Are these companies just kind of an elaborate, financial daisy chain? And, other things that go bump in the night, private credit. Markets have been giving us some surprises for those paying attention. So we'll break it all down and separate the tricks and treats on Protect the Pile. So let's get to it. How'd I do? That was my attempt to do like Lewis Rookheiser by way of Jay Cal on the All In podcast. I
Yeah.
need a rating from you two on a scale of 1 to 10. How did I do?
How about 11?
Yeah.
Yeah. That's all right. I got the Russian judge is giving me a 2. All right. So
I mean, I was gonna go with an 8.5, but now I feel like kind of a dickhead. So,
these are rookie ratings. You really got to go more like a 6.1, like be more critical. Um, all right. So anyway, let's get it's our first episode. So like we'll see how whether I come back to that or not. All right. But I thought it'd be good to start with some background. And I think maybe Sam, we'll go to you first. I mean, obviously, I think some people from Hedgeye Nation are familiar with you. We'll interview each other here for a little bit and see talk a little bit about your investment background.
Yeah, sure.
On it.
Like I think mentioned this before. It's like over 30 years in this business. That's a long time. And two different firms. Well, this is the third one now, but I started my first 15 years at a global asset management firm based in London called Baring Asset Management. And so I kind of really learned kind of old world macro there because that's the way things were being done back then. And then as luck would have it, I got a call from a headhunter about the, opportunity to work with Ned Johnson, which was, you know, you get those calls, you dream about getting those calls. And I was very lucky to get that call. And I spent 15 and a half, 16 years with them managing his family office, public equity investments. And he passed away, things changed. And I'd been in touch with Keith from the time he started the firm. And as luck would have it, it was all lining up with his creation and launch of Hedgeye Asset Management, and here we are. And so it's been, as you said, it's been a lot of ups and downs, a lot of lessons learned, And but still, you learn something every day. And that's what's great about this business is you can never master it. You can always improve, and along the way, you learn a lot about yourself. I think that's what I found is I learned a lot about who I am as a person and kind of what really drives me, what my risk tolerances are. And so I think if you do it the right way, which is hard, you can learn a lot about yourself and humanity, which is good and bad.
Yeah, right. It takes like some humility to kind of just learn about yourself and observe
Right.
yourself almost dispassionately and figure out how you can not make the same
Yeah.
mistakes again and again, right? I mean, I think I said this when we were doing the investment summit that, there's if I was interviewing someone and I asked them what their biggest investment mistake was and they say they really don't have one, I'm always like, ooh, well, then you're immediately off
Yeah.
my
Red
list. If you
flag.
can't admit to an enormous mistake at some point, then I know you don't have enough experience or you're lying to me, and either one of those is probably not a good
Right.
fit.
Right.
Um, Maybe just I'd love to get like an anecdote of sort of or two, maybe a little story that's kind of a formative investment experience for you, right? That codifies something in your mind that really like, it formed part of the way like of your essential source code of like how you invest. And maybe like give us like a story or something that from
Sure. I
that.
mean, the one that comes to mind, I might have said this before a few months ago, but I remember going into Ned's office in December 2008. So obviously the world's falling apart. Everybody's going bankrupt, and it was kind of the end of the world situation. And my portfolio that I was managing from was down a lot, obviously with the market. So I went in thinking, you know what, I'm going to get fired. Like literally a week before Christmas. I'm only like 8 months into the job. I'm going to get fired today. But I went through my presentation with him, and I put performance right on the first page. So I wasn't going to sugarcoat it. I was like, okay, this is it. This is good. This is what it looks like. And he looked at it, didn't say anything. He just looked at it for like a minute, and he flipped the page. And he looked at me and says, let's talk about what we're going to earn for the next 5 years. And I spent the next hour and a half going through holdings, and we talked about stocks and sectors. And I came out of the meeting like one, relieved I still had my job, and two, it just gave me a brand new appreciation of long-term investing. I mean, this guy obviously had seen it all. He just did not care. He was like looking forward to the next play, to where the puck's going. And whereas like I'd come from institutional retail world, where you live and die by the quarterly performance, and you know how you measure it against your peer group.
Well, it's like the crisis is an opportunity, right? And it's like his background, he'd had so much experience that,
Right,
no one wants to live through the drawdown.
right,
But at the same time, there is part of you that's like, hey, the silver lining of the drawdown is like,
right.
I'm going to get a shot at some incredible things here, right? Like, I mean,
I mean, he's
oh
somewhat
09,
unique.
you don't have oh
Obviously,
09
he's
without
got.
08, right? Like, it's
Yeah, I mean,
like,
he's a definition of long duration capital. So it's a unique feature that your family offices have. But to your exact point, is like these things, whether they're big like 2008, or like the smaller ones like we've had all year, where you've had these VIX spikes and degrossing and deleveraging and liquidations by hedge funds. They're painful for like a week or two because we happen to be on the long side of some of the names that they are selling. But to exactly your point, those are like always opportunities to like kind of dial up the portfolio. As I said to Keith a few weeks ago, like clean up your portfolio and get ready for the next move. And that's kind of what big and small, those events give you the opportunity to really tee yourself up for the next move in the market. And that's huge. And the worst thing you can do in those situations is be crouching on your desk, praying for something. But you want to do the opposite.
well, and not able to zoom out and recognize that like everybody else is living with the same issue right now, right? There's like, you sort of get the sense you're alone somehow and like you're having this terrible time. Like when the market's selling off, everyone's having
Yeah,
some rough
exactly.
times. Nobody's doing perfectly in that.
Right.
All right. So let me pivot to Robert. Robert, I'm gonna put you on the spot because I didn't even give you a rundown that I was gonna do this to you. So yeah, just some formative investment experiences and a little bit about your background. As you say, you've done Hedgeye stuff a bunch, so people are probably more familiar with you than Sam and I. But go ahead.
Yeah, no, appreciate it, RPK, and yeah, I mean, I don't quite have the pedigree you boys do, and David as well, but I kind of cut my teeth in equity research and sales and trading across. I've been kind of focused on capital markets for 20 years now. So I started in '06, and yeah, it was an interesting time to be kind of a rookie on the sales and trading desk, going through just looking at the screens and seeing just turmoil everywhere. Just speaking of kind of, '07 or '08, right? I mean, it was the good times were great for those first 2 years, and then it was like, holy shit, what do we do here? So it was, I think, from a formative standpoint, looking back, I think you could really see the guys on the desk that had some form of process, right? Or at least, understood how to kind of speak with their clients and stuff like that, versus the ones that are just staring at their screens and like kind of deer in headlights. So I think that was certainly something that I learned at, when I was, 24 or whatever, at the time. But then, you know, realistically though, my kind of investing career really took off when I found Hedgeye in 2020. So it's just, I remember there was a macro show at some point in the summer of that year in 2020 when so I discovered Hedgeye research in March, and I remember Keith just saying something, alluding to something about how, so grateful for a bunch of, new subscribers, and that he knew that there were people out there that would be, turning into investment advisors or portfolio managers, now that they kind of like, found the Hedgeye research. And I think I'm living proof of that, right? I'm 5 years later, yeah, 5 years later, here I am.
So yeah, I mean, I now I get to talk about myself. So that's I'll let you guys interview me. How
I
about
was gonna
that?
say, I mean, are you
Oh,
gonna
yeah.
also
I
pose the
think let's.
questions to
Yeah.
yourself? Like,
I mean,
this is,
why don't you
yeah,
stand
this is
back while I have a
leading the witness
conversation with
scenario.
myself? Yeah, no, I mean, so actually, well, I'll give you one anecdote that I think will be that ties into sort of my relationship with Keith and Hedgeye too, as well. Because I first came across Hedgeye's research when Keith was launching the business, and I got an email forwarded to me, I think, with a newsletter he was writing at the time, or blog. I think it was a blog more than. And literally, someone forwarded to me like, "Hey, take a read through this, and this guy's thinking about putting a paywall up on this. Do you think it's worthwhile?" kind of thing. And I was like, yeah, this is great. And so I feel like I watched it really right from the start get going. But speaking to like the thing that resonated the most with me is actually one of the most formative investment experiences I had was the very first sort of conference I attended. So just to give you guys a little bit of background where I started, I came out of college. I was like a English major and philosophy major, and I knew that like the Dow Jones meant something to somebody, but it certainly wasn't me. And I mean, I kind of was, I took Econ 101, so like I kind of had some idea. There's an economy. I'm part of it. There's a thing happening out there. And what I found was I was actually started off like playing in a band. And my first job, because I figured out that you can't really wait tables and play in a band at the same time because you're kind of needed to be both places. You're either playing or you're waiting tables, but you're not doing both. And so I was needed a day job. And so I found a day job as a fact checker and editor for a guy who was a former Wall Street columnist for Money Magazine. And and he had kind of like gone freelance and was doing like rock climbing articles and other stuff, but he wrote this stuff on Wall Street. And I found it like all of a sudden I was like reading this stuff and I'm like, yeah, I'm supposed to be checking your spelling. Is EBITDA a word? What is this? Like, and he was like, I don't have time to explain all this to you. So here's some books you could read. And suddenly I was like, wow, this is fascinating. So I was trying to find a way into this world because I found it all very interesting. So I my first job on the sort of related to Wall Street was actually on kind of like the sell side, working at like originally almost like kind of a retail broker who was kind of had an institutional, quasi-institutional business. He had a little bit of institutional and retail. So they allowed that back then. That's all kind of gone now. But and so I, one of my jobs was like taking notes on the like in the morning off of like the hoot and holler. Like the morning call was done over this speaker. And I was like, this is how do I get to the other side of this? This is like that's fascinating. I don't want to be listening to this. I want to be on the other side of the call. So I started doing my CFA and yada yada yada. Long story short, I get to one of the people who recommended me for the CFA program. It was an informational interview. I had met with a woman who was a portfolio manager at Schroders. She called me back like out of the blue, like 6 months later, was like, "Hey, our research associate quit, and would you be?" And she said you were interested in working at buy side. Would you be interested in coming over to do this? So I joined like to as a originally as a research associate, and a year later, our healthcare analyst quit. And she was like, well, I could hire a healthcare analyst, but I'd have to that's going to be a long process. Like, why don't we just hire another associate and you just become our healthcare analyst? And I was thinking to myself, like, that's insane. I
Hmm.
have no idea what I have no idea what I'm doing. And but I think at the time she thought, well, I can train him up and I'll watch him and like teach him how to do this and like we'll just go slowly and that kind of thing. So I go off to my first, this is all to get to the punchline, is when I go off to my first healthcare conference, which was actually I think the Goldman Sachs healthcare conference out in like California. So one of my
Silverado?
what's that?
Was it Silverado?
Yeah,
There was a
it was
famous Goldman conference out there that was
it
in
was like
Napa Valley.
Laguna Niguel actually. It was down in
Was
like
it like,
Dana
okay,
Point or whatever down that way.
right.
And so I go out to this conference and I go to one of like my very first meetings, right? Well, not even a meeting. I was going to like my very first presentations. Like I go and sit down and I'm kind of like doing the like, what are other people writing down? Like just make sure I understand. Like, and no, unbeknownst to me, I had happened to like wander into this thing and sit down next to who I found out later. I won't drop her name, but she was like a really like famous healthcare hedge fund PM, right? And I don't know this. I have no idea who she is. I'm just sitting next to her, kind of like trying to copy off her homework. And she had this really interesting setup. Like she was taking her notes not only like in notes, but she had them in like boxes. Like she had like comments like associated by like revenue margins, like capital structure. Like she had like these boxes and was like writing down the things in it. And so as we're getting up to leave from this meeting, I said to her, like, sorry to bother you. I'm like, I just saw that was really interesting how you were taking your notes. Like, can you just, is that a common thing or how did you figure out to do that? And she was like, oh yeah, I'll just give you a tip. Good analysis is about the rate of change and good portfolio management is about the rate of change on the rate of change. And she walked away.
Wow.
And I was like, like, wait a minute. And I like all of a sudden I was like, oh, wait, I think I understand this, right? You're listening, watching for change, looking for how is that change accelerating? Is that change like that's the way it was. So once I came across Hedgeye's research and they were talking, and Keith talks all the time about rate of change of volume, rate of change of price, rate of change of volatility, right? Rate of change on rate of change. Like this is all like it spoke to exactly kind of my investment DNA and the words you often will hear me say is like, I can't stand the word catalyst. What I like is something like event path, right? Like what's the change that's coming that will change the conversation? I can't stand words like catalyst because they're very undefined.
Mhm.
Um, but anyway, that's my long story I gave you guys. I just did a flyby on about 25 years of investment
Yeah,
experience, summed up in one tiny story.
right.
All right.
Great
At,
story.
at the risk of this going on too long, let's get into some actual topics. Does that sound good?
Sounds
Sure.
good.
All right. So first one up. I think I had put up it's a reference to I think it was True Detective where the guy talks about time as a flat circle. Well, so there's obviously some questions looming about the circularity of the financing in AI. I alluded to it up front. Let's just kick it around. Maybe I'll put a quarter in the machine and let Sam go first on how you're thinking about this because OpenAI is now talking about an IPO in I guess I don't know. They're throwing 2027 out there. I can't wait that long to read this. It's going to be
Yeah,
that
it's going to be a fun
prospectus is going
S1,
to
that's for
be
sure.
amazing. I mean, I think I said this on Twitter the other day, like or X, sorry, that the related party transaction section alone is going to be just like a summer beach reading.
Right.
But yeah, let me just with that jump off point, maybe how you're thinking about it, Sam.
Yeah, I mean, look, I mean, the optics are clearly not great, but I honestly don't think, I think it's too much of a big deal that people are making about it. Because if you look at what was actually agreed to and actually signed, it's all kind of like very sort of, yeah, we're going to buy X amount of GPUs, we're going to invest this. There's no like concrete sort of real plan or deal to do it. It's kind of more aspirational. The one deal that is semi-concrete is Oracle's deal with OpenAI because it's in their RPO. So clearly there's some due diligence baked into how that's going to flow. And then all the connection between them. A lot of it, I think, so like I said, I think people are making too much about it. But I think if there's one thing I think that matters more is I think it's a lot of game theory. If you think about what happened a few months ago, Meta like did a complete raid of engineers across the space, particularly from OpenAI. So coming in as a potential new entrant. So, one way OpenAI is kind of put Meta out in the cold is basically said, we're going to spend $1 trillion over 10 years. We're going to sign deals with NVIDIA, AMD, Avago, Oracle. We're going to spend hundreds of billions of dollars building all these data centers. So what they eventually actually did is they froze the whole supply chain. They froze every other player in the space because now you got to think if you're Meta, like, okay, wow, this guy, I mean, this is a big number, and we're a publicly traded company. How are we going to match that? And Zuck being Zuck is like,
Hold my
damn the
beer.
torpedoes. You know,
Yeah.
I'm going all in. We're going to spend until we get the super intelligence, which I don't think they'll get there for at least 10 years. But he's like, I'm betting he's going to talk like he's betting the farm because AI potentially is existential for Meta.
This is fascinating because I think this is kind of the key point you get, like, which is that
Yeah,
they're all committed to the bit, right? I mean,
right.
in some ways you can, if you're really bullish on this, you say like they all want to get there because these services are going to be huge. And if you listen to, I listened to a podcast with Jensen a couple weeks ago where, I don't tune into like every single NVIDIA meeting, right? Like I don't, so I'm not totally like fully inoculated to Jensen being Jensen. So I was like, I'm sure if you like listen to him all the time, there's some frog boiling there where like you can kind of take it with a grain of salt. But I only check in periodically and to actually get the primary source, right? And so I listened to this podcast interview with him and I shut it off and was like, I don't know if that guy is a cult leader or a crack addict. Like, oh my God, like this is like
Yeah.
wow, we are definitely firmly into the like, Scarface has his face down in the bowl smoke,
No,
right? Like,
he's
I mean,
he's an evangelist,
like right. I
like
mean, he's
John
talking like
Chambers,
he's doing numbers
at
like
Cisco
right,
back in the 90s was an evangelist. I mean, he really preached the whole network infrastructure of the internet.
right.
And Cisco became Cisco. I think that's what Jensen is doing. But there's nuances among all these players. I mean, if you watch them carefully, Amazon and Microsoft are amongst the most disciplined of all of them. I mean, they're spending, but they're spending within free cash flow. And all these guys are about to get a bump up in free cash flow with this tax bill that's going to hit next year. So these guys could raise capex by billions next year. Their operating cash flow is going to go up because of the tax benefits. And guess what? The free cash flow is going to be the same.
Yeah, they're not. I mean, so that's an interesting point. Like, because I think you look at Meta's balance sheet on the one hand, like they've spent down all the cash, and they're, well, not all of it, but they're actually now down. Their net cash is effectively gone,
Right.
and but they're a free cash flowing business generally. So like
Right.
they can continue. No one's going to stop them from borrowing. I mean, we can watch the terms that they do with these borrowing on. So
Right.
as I say, they're committed to the bit. Like they're going to do
Right.
it. And look, ultimately, the rubber meets the road. It's just going to matter of like whether there's an ROI on these things. So Jensen can go out and throw these big numbers around, and he's like, the guy asking him on the podcast is like, what's the market for AI? And he's like, oh, it's 10% of global GDP. Or I mean, sure, pick a number. I okay.
Yeah.
Like, I mean, nobody knows. I don't know. He doesn't know. Like, nobody knows. I mean, they
Yeah.
can
I mean, yeah,
directionally kind of
yeah,
think that,
yeah.
but that's where,
All these guys are keying off of is token growth. And token growth is like the only measurement they have right now, because that is basically you or some enterprise typing in a query for some AI related output.
right.
So that's like the measurement is okay, what are people actually putting in and asking for. So that query growth is driving investor spend. And the company that you really got to pay attention to is Anthropic, because Anthropic is almost purely geared towards enterprise. And enterprises are paying those guys
Yeah.
for coding, for AI, for all the other intelligence they have. So that's like where that company is getting traction right now. OpenAI is searching for traction with consumer apps, and they'll get there. They're
Porn.
eventually going to go advertise.
Yeah.
They're going to get advertising to drive revenue.
Yeah.
And then, as you just said, they're going to IPO in a year or so, which is going to be, maybe that's the top in 27. That's like that's like the sort of flag and the sort of on the
Yeah.
ground where, okay, this is it. But that could be $1 trillion IPO.
Yeah. No, that's it. I think that's what certainly what's getting floated anyway, right? But Robert,
Right.
I want to bring you in, make sure we're not we just go back
No.
and forth because Sam and I could do this for hours and I got to keep the train on track here. If you
Right.
want to be any, I want to bring you in on this topic before I move to the next topic, which is going to segue, I think, generally from a continuation of this conversation. But go ahead.
Yeah, no, I mean, I listen. You guys kind of said most of it, right? It's. I mean, for me right now, it's like it's the flows are there. So the capital flows are supportive. If you look at our kind of systematic, what's being, pushed to the top of our list, it's ETFs like AIQ, EWI, SMH, QQQ, so these all have that AI exposure. And so all I know is like right now people believe in it. Longer term, does it look totally different? Most likely, right? I mean, I think, you mentioned Cisco. I think it's probably a really good analogy is, the landscape shifted a lot from the, mid to late 80s to the early 90s to let alone the late 90s going into the early 2000s, right? So, it certainly seems like we're at the beginning stages of this cycle, and there's likely going to be, companies like OpenAI that'll IPO and they'll and the cycle will kind of continue, right? So that's sort of but right now, most importantly, is if you're not long it, then you're being left in the dust.
Yeah, that's what I said. Well, it's sort of funny, right? We could sit here and say like, "Oh, this is crazy what they're going to do." I'm like, "But they're doing it." So, like, I mean, you can be in denial, or they're going to just like they're going to spend the money. Like, no, it's
Right.
not like they're going to wake up tomorrow and be like, "You're right, our stock's really high," and I think maybe we won't go through with this. Like, I just like that's not what's happening here.
Yeah,
The markets will ultimately tell them if this has gone too far, and so right now they don't think so. So,
Right.
yeah, and RPK, you and I talked briefly this morning, but I think you're seeing the flow through as well, like outside of the US. So some of the countries, whether it be Taiwan or South Korea, even Japan, right? Like these, a number of these. It's not, I'm just talking about broad indices, but they're, that capex spend is bleeding across the globe, and I think possibly it's one reason why country indices like Germany and stuff like that are also kind of staying elevated, or certainly the international mix. Again, the international mix in our system, it's recently kind of flagged again. It was mainly U.S. for the last like almost like kind of 2 months, and most recently it's sort of shifted to more of an international mix in terms of like wanting more of it. And
yeah.
again, like, is it the capex spend that's kind of going internationally? It very much well it could be, but again, it's just this is where the capital is flowing.
That's a good segue to our next topic too. So I was actually, I moved these around in the order because I thought this would flow more directly to this one, but this is what I called the pig and the python, right? So if anyone doesn't know that reference, and maybe you guys don't even know that reference, I don't ever know if that's one that like was just something, an
Yeah,
anachronism I got from like somebody I worked with, or like that's
yeah,
a
we've heard
common
of
one.
it.
But yeah, all right. So, the bell curve, it's like this giant thing that's coming through. So it's one thing to announce the spend. It's another thing when it actually happens. And then there's the lag effect to it actually flowing into the economy and what it does for activity. And so given, I just looked at this quickly the other day, and I know that this analysis is terrible because this is napkin math, but it was like just looking at what the top Mag 7 have given for CapEx guidance for 2026, plus what the utility spending is supposed to be next year, all together is like greater than the entire stimulus package in '09. Like when we were now granted the economy's grown. I got to look at the incremental, not just like I get it. There's all a bunch of caveats to that. but we still got the rest of the economy still doing stuff too. So like I just
Right.
it's fascinating like how big this is, and so it does make me think like as we talk about a lot, the Keith's mentioned ad nauseum on the macro show, like this 3-2-1 kind of count that we could actually be seeing see this really flow through to the real economy over the next. I mean, it's already there to some degree, but it'll flow through even more. And then, as Robert pointed out, like this is not just the U.S. Like there's people spending this everywhere. So I don't know. Like maybe I'll go to Robert maybe first if you want to pick up where you were there, and then Sam if you
Yeah.
want to in.
Yeah, so it does. I mean, the Q3 numbers will become actual soon. It does look like from our latest estimate, it's going to be 221, which is, even better and really could be the, one main reason why we've been seeing all-time highs across the board, in many global capital markets. But yeah, I mean, I think, yeah, just going back to what I mentioned a minute ago, it's, South Korea has been an awesome performer year to date, and certainly is, just moved up to the number one position inside of our, what we call the Hubble, our Hubble system, which is our, systematic kind of approach to this process. So yeah, so you're seeing that, and exposures like AIQ, SMH, these things are all, again, I think Taiwan's another interesting one, and even India. You and I went back and forth a little bit. I sent you some data on that.
Yeah,
What kind of, so again, I think even India, where they had been sort of written off, or not written off, but like the signal was terrible in the last sort of 3 to 4 months, and just kind of recently picked up steam. So could that be, trade related? Could it be just, kind of growth in CapEx going, basically flowing into their economy? Who knows at this point in time? But I do think this international kind of, again, I mean, like, yeah, this international sort of expansion is certainly one to be paying attention to.
Sam, any thoughts on this?
Yeah, I mean, I agree with you. I think if you look at the AI theme or trade, it's so much more than these big tech companies. I mean, if you look across industrial stocks, um, some of the networking equipment companies in the technology sector, even energy. I mean, natural gas prices haven't really kind of moved a whole lot. Obviously, we're going into the winter, so you saw pop in natural gas this week. But the signaling has started to flow through from those big capex spenders to other parts of the economy. If you go regionally across the country, electricity prices have been going up for several years, but particularly in areas where these data centers are being built, like in
Yeah,
Virginia
Virginia,
and
yeah, that's
Texas
right.
and some of the Midwestern states, you start to see electricity prices tick up. So that, I mean, as you mentioned, utilities, those are signals for utilities to build capacity and bring some more load online. But it takes time, particularly the biggest bottleneck for this whole industry is electricity and the
Yeah. And the
capacity comes
constraints
to.
there are real, right? We talked about, you and I were
Yeah,
like offline, we talked about this, that like, you listen to like GE Vernova, which is one of the biggest gas turbine manufacturers in the world. It's been in a down cycle for 20 years, right? I mean, it hasn't been because there's been no load growth in the effectively for almost 20 years.
right.
And now we're seeing real load growth. And not only that, we're starting to worry that we're way behind the curve on building supply. And like, yeah, you could hear it on their conference call. I mean, they're they're taking reservations to get into backlog, right? I mean, that's
Mhm.
not even they're
Right.
not even in backlog. You're just getting the ticket and waving it in the back, waiting for the deli man to call on you, right? Like for your order.
Yeah, I mean,
It's
the lead times, as you said, like are so long for those big turbines. So, like in the meantime, these companies or these big data center guys are trying to fill the gap with anything and everything that generates electricity, regardless of how efficient it is. So, Caterpillar's solar business put up a massive backlog because there's enough of those units around, and now their backlog is growing because they're starting to hit capacity limits in terms of manufacturing. But whether it's Halliburton or Baker Hughes or Caterpillar, any sort of generating equipment, regardless of the size, is being pulled into this because they need power like today. And the one area that you and I talked about recently that is a surprising area that people kind of lost track of is solar and battery storage.
yeah,
And that is faster to bring online than a big gas turbine. So First Solar, some of these other solar companies are putting up big backlog numbers. and Bloom Energy, which you mentioned, we talked about a couple of days ago. They've got to deal with Oracle and OpenAI. So their sort of stationary battery storage is being deployed. It's going to be deployed everywhere because you need not only just for backup, but now you need it for like, okay, if I have solar, I need to store it.
Yeah.
So
Yeah, no, there's
it,
certainly, and
it's
then
the,
yeah, Bloom is interesting because I think I met with them years ago, and at the time, I mean, this was back when I was working on the impact fund. I met with them, and they
right.
had just come public, and the hydrogen, they were a hydrogen fuel cell story then, which I was already very skeptical of because I won't derail this episode on my rant around hydrogen. We'll do that another time. But
Don't bring Vance Carver on then too. It'll be like a 3 hour
Oh, well,
episode.
all right, tag that. We'll do that as a special episode where
Yeah.
you get to just watch Vance Skyver and I have drinks and rant about hydrogen
Yeah.
for 2 hours.
Yeah. Yeah.
Um, but no, but I always thought it was interesting that they were when I met with them, they said, oh, we're like they kept telling themselves hydrogen, but they were like, well, we actually work with a lot of things. Like they can work with waste gas, they work with natural gas, they work with other things. And but the power was kind of expensive at the time. This was 6 years ago. I was looking at like the per kilowatt hour kind of delivered. I was like, ugh, this is like, I mean, great, but I don't know how big the market is. But run the movie forward and the power prices are coming to them, right? It's like it's going up, and not only that, it's if you've got gas supply, it's consistent energy, and then it's also it's got it's deployable at least for now, which is to this point about this backlogs. I mean, I think
Right.
they mentioned on their call that they had an order they were supposed to deliver in 90 days and brought it in 55, and you're like, well, in this moment when everyone's completely hot and bothered to make sure they're like getting this stuff done as quickly as possible, that's certainly an asset for them, I think. But I mean, so tons of questions around the technology, I suppose. But in the meantime, you've got some deliveries. All right, let's keep moving because I'm keeping my eye on the clock and I don't want to run this too long. I mean, if the domestic economy does pick up, small caps, right? That's always been like kind of a place where when it broadens out, that does help you, help the smaller companies. And certainly when we look at the setup here, I mean, small caps in general are up, what, 12% year to date, something like that, versus the S&P. They haven't been able to quite keep pace. But they're signaling bullish trend. Certainly small cap growth is up a little bit more. So I think that's closer. Maybe that's up like 17%. I think so. It's more closer to the matching closer to the S&P performance. And then obviously Keith's talked about it signaling bullish trend. The rate of change on earnings right now, if you look over the next couple of quarters, and I think I had put this on X a couple of weeks ago, that setup actually looks the same to me as like what you saw with like the value growth trajectory when you were coming off of like 2020 into 2021, right? It's because the value stocks were comping the economy being shut, and a lot of growth stocks were comping everybody's Zoom calls, like doing Zoom calls at home. So it was like, oh wait, we now have to like these are now the comps you got to get over, and vice versa. And we had a strong run for value. So it's certainly something like it's an interesting setup for small caps. This is not really necessarily your bailiwick, Sam. You tend to be more in the larger cap growth. So maybe Robert, I don't know if you've got like,
Yeah.
how are you guys thinking about it?
No, so I mean, it's interesting you mentioned it because recently in the last sort of 5 to 10 days, the small cap va or like value's actually been sort of getting a flag. So whether it be small cap value, aka IWN, or even the S&P 500 in IVE, those both have kind of like moving up the ranks.
And just that's in your
Um,
capital allocation Hubble
that's from
screen.
the
Yeah.
yeah, that's from like from our kind of systematic approach to
Yep.
or evaluating the overall kind of opportunity set within global macro landscape. So I do think it's interesting because value is not something that certainly has been well, I don't think it's really a prevalent exposure within most portfolios. And so if there is a time that where it could come back to kind of like life here. Certainly
Well,
a
and it's
quad
like
one environment usually does help.
I wrote about this in the early look last week, right? Like value investors are very scarce now in the and boy, small cap value investors,
Yeah,
you want to
yeah,
like that's like
yeah,
yeah, looking for a different kind of unicorn right
yeah,
there. I mean, like that's definitely a small cadre of people out there
yeah,
now, and but yeah, to your point, I mean but historically right? That's actually when the economy broadens out and does improve. So if it is a 2-2-1 kind of setup, like that, it could be a situation where like that actually does lead to an improved that supports that improved outlook for smaller
Yeah, and
companies.
even and I'd say even like the quad four that's like that's looming in Q2, right? So like the first half, everyone's kind of looking at the first half of 26. But that GDP number, so like the decel is from 2.77 to 2.62 at the moment. So, it's a relatively, shallow kind of quad four, and oftentimes that, capital markets can sometimes kind of look past that, especially if it's sort of an elevated number from where we've come from. So if you kind of look at where we've been the last sort of 3 quarters, we've been sort of closer to 2% growth here in the U.S. So to have kind of a number north of 2.5, I think that could still bode well, even if it is a quad four on paper, if that ends up coming to fruition.
All right. Maybe I'll pivot to the next topic. SaaS software. So another kind of area that's lagged, question marks around whether it could catch up, right? I mean, if you look at like broad software indices, they don't look like they're that bad because Microsoft and Palantir and a couple of other the big winners here are in it, but it's very bifurcated with
Yeah.
some of the other well-known, household names around investment circles anyway, like Salesforce, ServiceNow, Adobe. These have been bad. They've all been bearish trend. Um, so I've just been kind of thought it would be at least spend a minute or two kind of kicking around, just generally what we're like, any, questions we have around this. And is AI really the boogeyman that everybody thinks it is, or are we overdoing it? I don't know, Sam, how are you thinking about it?
Yeah, I think it's a mixed bag. But I think there's going to be some companies that survive this because I think we have to think about ServiceNow, which is a name I've been looking at recently. I think, and they had great numbers on Wednesday. I think if you look at a software company like that, where they're actually delivering like a really meaningful ROI to a company, the company's going to have to think really hard about, pulling that out and the time it took to install that and the people hours it took to install that and maintain and run it. And it's delivering an ROI. And I'm going to pull this out for some unproven AI agent. I think we're like for some software products it's going to take a long time to replace them.
Yeah.
Whereas other ones, I think where there is probably much more of a direct competitor threat, I think those you really do have to think hard about. Okay, I mean, Adobe is one of them where Adobe's fighting, and I think right now it's narrative because if you really look at the specifics of how Adobe's products are used, and like a large enterprise isn't going to take a flyer creating a commercial on Midjourney where you have no idea where the content is coming from because the last you need if you're Coca-Cola is you get sued because whatever image you generated on Midjourney came from somebody and now they're suing you. It's
Yeah,
proprietary
I think
content.
this is the right. I think you're, at least, I mean, you're preaching to the choir here. I think you're thinking about it the right way because I've been sort of curious about this. It's sort of an unfinished thesis, is why I wanted it on the list. I thought, well,
Yeah,
if we continue to do the show, which I hope we will do, like these might be topics we might even come back around to because these are sort of like what I'd call just sort of unfinished thoughts, right? Like I'm just kind
yeah,
of like, oh, not sure yet, but I want to know. I know what the narrative is, and we'll certainly be watching to see how the signals, directionally point us to it. But yeah, I've kind of had the same thoughts. Like the framework I've been thinking about is like in what you were saying puts with what HBS put out just like a couple of weeks ago. I think they did a survey of enterprises where like 90% of these projects are not happening right now. And it's mostly around the concerns that you have. And one of those things is that many of the companies that are pitching them the projects are startup and fly by night. And like, as anyone knows,
exactly.
literally any startup, and this was like news to me when I first like worked on the pricing when I sat on the pricing committee at around looking at our privates at Wellington. Like I was like, oh wow, like a lot of startups are like 6 months away from shutting out the lights. Like even if they're big, like they're like famous household names, like
Right.
you'd be like, wow, like if they don't raise more capital, like this thing won't be around. Like, and so you realize like that, like any customer looks the same way at some of these companies. And so it sort of asks the question like, all right, well, they better be coming with something earth shattering for me to take the risk on putting this into the system. And that kind of tips you back to like, and this is the question I've been kind of kicking around, which I know you and I've talked about offline, is Agentic AI actually first delivered through many of these companies. And so that'll be like a question. It'll be an interesting thing to actually to look for like hints with this, talking to the companies, looking at their transcripts and their presentations to see how they're doing. Because they might be like, one of the risks of all this spending is that we don't see the ROI. And they might be
Yeah.
one of the these might be some of the companies that are first to actually capture real ROI on some of this. And therefore like it could actually justify a lot of they
Yeah,
could
I
be the
mean,
ones
like
that help justify
ServiceNow
the
is
CapEx spending.
already has adjacent AI features with some of the core products already. So they're already trying to deliver that. I mean, how good they are, I don't know, but I mean, they're starting to get attach rates with some of their core customers. So, but to your point, that is going to be the gateway drug to like the actual whatever agentic AI is, because you're going to go with somebody you trust, like a ServiceNow or a Microsoft. So, okay, deploy this for me. Let me see how this works in a small setting. And if it works, I'll expand it slowly. And then we'll measure the ROI. You're not going to sign up some recent IPO that's got an agent AI that's going to fix your IT needs, because
Right.
no business is going to do that.
Yeah,
There will come a time, maybe in the future, where
that's right.
once AI is built and you have native AI software companies coming out that really do have something earth-shattering, then like we did with the dot com. It wasn't until you got like Facebook, Google, and Amazon, and eBay that literally invented new ways for you to do things.
Right. Right.
But they were internet native companies first, and then they kind of grew out of that. But so we may see that in the future, but we're clearly not there yet.
All right. In the interest of
If
time. Oh, sorry. Go
if
ahead,
I'm
Rob.
no, just if I may, I think just to piggyback off of your guys' comments, I think the integration of like the AI within their software, within their services, like the SaaS software services, I think that's a huge piece that if they rush to market with it, and I think you've seen this a few times, like if they rush to market, it can be almost adversely impactful, right? Because
Yeah.
Yeah.
if the user experience isn't robust or good, I think Copilot actually almost like shot themselves in the foot a little bit by like kind of pushing Copilot as the
Yeah.
AI
They tried to
element
go
and
out with a monetization scheme right
right
out of the gate. And like, how much are you
and
using Copilot?
it's
Yeah.
stunk. Like it's not good. But oddly enough, like the Adobe AI is actually pretty decent. Right.
Yeah.
So I don't know,
Yeah. Yeah. Yeah.
so I don't know
Yeah,
if
that's a
they
great point, Robert.
yeah. So I just think like, again, like it's a big now Copilot it's funny enough, Copilot's gotten significantly better, but I think there's a lot of people that are just like, oh, Copilot, like no way, I'm gonna go use, Anthropic or ChatGPT
Yeah.
or
Right.
OpenAI
Right.
or whatever, right? Because, they just sort of yeah, they just didn't really do a great job upon launch, right? Or when they were really pushing it. So
Yeah,
I
no,
just
that's
think that
great. No,
integration is
great.
huge.
No, totally great points. And actually,
Yeah.
so I mean, I'll pivot, make a hard turn to our last topic before we close this out. Um, credit cockroaches, the Jamie Dimon. Obviously, we hit First Brands. Are these the dead canaries of a credit cycle? What maybe just thoughts of how you're framing it up and how you're thinking about it? Maybe go back to you, Robert, and then go to Sam, and then I'll pick it up.
Yeah, I mean, credit and fixed income in general right now is interesting because, big piece of this is reliant on like what how is the Fed going to kind of finish the year and then who may be the new Fed chairman in 2026, right? Like if we get more rate cuts, especially as in the growing economy, then I think some of these canaries in the coal mine are going to kind of just be one and done. But if you have a Fed chair or somehow Powell, it's very unlikely that Powell remains. But if inflation sort of starts to tick back higher, right, and then all of a sudden they got to fight that again, then I think that's when when you have sustained rates at a level that people companies haven't seen in really, I don't know, 5, 10 years, really at the end of the day, then that's when you start, then all of a sudden the dominoes start to, or like that, that little pebble starts to pick up steam and catches, some pine trees and all of a sudden the path gets larger and bigger and that kind of thing. So I think it'll be really interesting. I don't really have a good answer right now, but certainly from
No, I mean,
our stand,
you're in good company. I don't think even Jamie Dimon knows the answer right now, right? So,
yeah,
and he's sitting on
yeah.
top of the biggest bank in the world. So, I mean, it's a little bit of a question mark, right? I mean, I almost put this in my upfront header that, when I was writing my Rookizer opening, that like credit spreads are as tight as a cable for a high wire walker.
Right.
Um, because you got about the same downside and about
Hmm.
the same reward, right? Like
Hmm.
you get paid 6% to take triple C credit. You're like, all right, I hope you get to the other side. That'd be great.
Hmm.
Fine. But like if you hit a credit cycle sometime in the interim, like that's gonna be bad. Now I had actually had an unfinished thought around this I had sent to Keith, which was like, I wonder if almost there's some if you've got direct lending, which is blown up, right? And I just tend to think like pouring capital into something doesn't necessarily make more opportunities for capital. So all you do is ultimately reduce your opportunity for returns if you just dump capital into things. Um, and so there's been such a race to get into sort of this direct lending, direct, private credit, that you kind of ask questions like, there's no way these returns can stay the same. They have to kind of come down, and you have to be taking risk you're maybe not even aware of. And the flip side of that is that we're almost getting, if you get adverse selection there because of the incentives, are there like almost like an improvement like in the credit that's inside of junk because like in high yield because like I mean there's been so any of like the credits that can are just going quietly to direct lending because they can they have much better terms like and direct lending tries to sell that private credit tries to sell that as like well we're talking to them one-on-one, this is great, but at the same time the percentage of the stuff that's paid in kind with stock and or just more debt being IOUs is going up. So we know this is true. And this is kind of like we can see that. Now the question becomes, and a few canaries drop dead, but the question is like to your point, like Robert, like that's now it becomes a function of like is liquidity tighten or does it get looser? If it gets looser, this game can go on for a while longer. These guys can continue to extend and pretend in some of that credit, and like it doesn't, and it's not going to matter. If it doesn't, then it gets more colorful. No, Sam, any closing thoughts on this?
Yeah, your point about public credit versus private credit is a good one because I think with the public markets, you've got market due diligence and all this stuff. So, crap's going to be, is going to be priced at crap, and good stuff is going to be priced well. The private credit space is like, how that's getting priced, nobody knows. But I think that's where, the spreads tell you right now that it's contained. Whatever's happening in what we see in terms of subprime auto is contained. It's sometimes this is coincidental. It spreads in and of themselves aren't necessarily always a great leading indicator. Like when the shit really starts to hit the fan, then the spreads start to blow out, and that's when you start to have to be careful. Like the way I try to deal with it from a portfolio construction perspective in what I own in financial sector, I'm avoiding
Yeah,
those
you just first
spaces.
start carving out the obvious exposures
Yeah,
here. If it's a
like,
worry, like take it out, right?
and
Like
you
that's
can
just
you can
sort of, yeah,
see it in the charts. All the
yeah,
stuff that's kind of tangentially, either directly or tangentially related to, they're all rolling over. So all the alternative asset managers, they've all rolled over. Your point about returns are going down. Blackstone themselves came out in their earnings call. So look, the returns that we saw in private credit the last few years is that's not coming back.
yeah,
And
yeah,
then you see like regional banks that are kind of affiliated to this stuff, they've rolled over. All the sort of subprime card names that were kind of playing this auto space, they've all rolled over. So, that's like basic, you start sort of, avoiding the areas where the landmines are. Even if there are no landmines to go off, you
right.
start avoiding it and you go up the quality curve to companies that are like, like the biggest and the clean, hopefully the cleanest, where if there are stuff like JP Morgan said that they had exposure to tricolor, it was like it might have been like a drop in the, like a
Yeah,
micro
sorry
drop in the
for
bucket for
JP
them.
Morgan. I mean, that's like a
Yeah.
like a
So
hair
like,
on a hair
all
on a
this,
pimple on their leg. I mean, that's not even
yeah.
like, yeah,
They
yeah,
probably see this every week, for them,
yeah,
but they kind of have to disclose it.
yeah.
But that's kind of how you avoid the potential areas of concern and just focus on where you're not going to be caught off sides with something like that.
All right, let's close this out so we can get to our quick hits. I'm going to start off with my first one. I'm going to direct at Robert. I had a group of categories just to give it, if we do the show again, I'll be doing categories of things. I'm just going to fire them off at whoever's here. And you get put on the spot a little bit. So I'm going to go, my first one is going to be my Skunkworks lead in, which is going to Robert. What's something you're working on research wise that you can, kind of talk a little bit about in just 1 or 2 minutes.
Yeah, absolutely. So, in the last sort of 10 days, we really dug a lot deeper into our vol calculations and how it's playing a role inside of our systematic kind of quantitative approach to investing. So, I'm really happy with what we've where we've gotten it to. So we've actually started to deploy it last really this week, and I think we're going to see that be a really good pivot and something that we've yeah, that's as we move forward. So I'm excited to for those.
All right. And my next prompt is going to Sam. Shiny object. What caught your attention this week? Any anecdote or interesting thing that came up on either a call or news item, something else out there that you flagged?
Yeah, I mean, nothing sort of new that we haven't talked about, but just, just kind of obviously with AI being such a big theme, I'm spending a lot of time trying to just track data points that are going on within the industry to either disprove or confirm what I feel is like what this thing's going to be. So I'm trying to make sure that I'm not missing anything. But I mean, you can tell how strong the demand is when Amazon just AWS deploys like a Blackwell rack and they start raising prices within a month or 2 months of that first deployment and pricing on the older chips that they have like A100s, NVIDIA's A100s, like maybe three generations of chips. Typically, in any sort of data center life cycle, the old chips prices come down, the new stuff are come online, and the prices go up, or they start at a high level. The old 2, 3 generation old chips prices have stopped going down. So
So
that
there's a
just
floor
gives
under
you
those, and they're coming in at a premium with the newer stuff, effectively.
right.
Yeah,
So like that kind of
that's
confirms the fact that demand is really strong, and
I.
Microsoft doesn't go to Nebius like a small neo cloud for excess capacity if they could do it themselves.
So if I mean, I did take Econ 101, which I did, mention up top. So it sounds like price is going up, which means demand must be shifting, which means the supply has to keep up. Just saying. I
Yeah,
think that's
it's
I think that's how I draw
exactly. Yeah,
those lines. All right,
right.
very good. Very good. So all right. Well, I was going to go one more topic on as new takes on takes, which is one we'll come back to, which is just somebody gets to rant on their stupidest thing they've heard on social media this week, or on CNBC or any of these other places. Old wall media, as Keith would say. I'll take this one myself, just as a general one, which is that I love how there seems to be these topics that like burble up and everybody talks about them for 24 hours and then they just quietly go away. I was like, it's like everybody was talking about on Wednesday, like, oh, the bread was terrible. And then the next day I'm like, then Russell outperformed the S&P the next day. And I'm like, the bread was a little better. Like, and I'm like, oh, we just stopped talking about it. All right. That's like, so we'll see. But yeah, it's more of a trend. You got to watch the trend, not just be a tourist, as they say. All right. We'll bring it to a close here. Maybe I'll do something fun to go out on. It's Halloween, if I hadn't already made that very obvious. Favorite horror movie. Sam's a movie buff, so I'm gonna go straight to her. Even if you're not a horror movie fan, the one that scared the crap out of you. So what's a good horror movie pick?
Yeah, I usually avoid horror movies because I'm a sensitive soul, so horror movies scare the shit out of me. But I mean, Halloween, the original Halloween was one of the great horror movies, and I think a lot of movies go kind of based off of that. I never made it through The Exorcist. I just could not handle. I mean, that was like Nightmare City. So I usually avoid the horror movies because like it's just like it's a little too much for my sensitive soul.
I hear you. I'm more of a action adventure comedy guy, but my wife and daughter love horror movies, so I get
Oh
subjected
God.
to them because, as you can imagine, I do not get to drive the remote control. So I'll pick The Descent, which if anyone's ever seen it, I don't know. I was squirming out of my chair watching that movie. Um, but yeah, that's it. That's on my top five, probably scariest movies I've ever seen. Robert, what do you got?
Yeah, well, my wife and son love to just pop out of anywhere and just scare the bejesus out of me. That's like, so that should tell you how,
This is just
how like,
practice for being an
yeah, like
investor. Yeah.
how I'm in Sam's camp where I do not love scary movies, but 28 Days Later is probably one of my favorites.
All right.
Yeah,
All
like so
right.
Zombie
That's
Land.
again, yeah, no, the
Yeah.
sequel, the most recent sequel was a little disappointing, but that original one is great. All right. Well, with that, I'll bring it to a close. That was it. We did it. Protect the pile. Well, hopefully we'll come back, do this again. If people like it, we'll keep going. Tune in for the next one. Hopefully we'll be back in a few weeks, do it again. In the meantime, you can follow us on, I keep saying Twitter, but I guess it's X. Elon would be mad at me for calling it Twitter, but the world wants to keep calling it Twitter. I'm at RP Kent. I know Sam is at Sam of America. And Robert, I think you're at Hedgeye RJM, if that's
That's
right.
correct.
Yeah, all right.
Yeah,
You
appreciate
can
it.
see our bios on the Hedgeye Asset Management website at hedgeyeam.com. Anything else to add, you guys, before we end
It's
it?
been
No,
a lot of fun, man. Really
yeah,
appreciate it. We can do it again.
All
yeah,
right.
agreed.
All right.
Agreed.
And thanks, thanks
If
for
we could
listening.
like if we can we like go out to like Thriller by Michael Jackson, that'd be
I
great.
asked
Yeah.
this question. I would like to do a song of the week, or every other week, or whatever we're doing this, whatever frequency we're doing this on. But I'd love to close on a song, but I have to figure out whether we can get sued for that or something.
Yeah, that's fair. That's fair.
Or we get blocked on YouTube or whatever
We
happens
just
when you put a song in
Thriller.
there. Yeah, yeah. I'll just get my guitar out and just close
Yeah,
on a
yeah.
song. I'll do it
Yeah.
myself. All right. Well,
Good
anyway,
stuff. Thank you.
that's it. That's our show. All right. Best of luck out there. Hopefully we'll see you at the next one. Thanks, guys.
Yeah. Have a good weekend, guys.